On the 28th of February 2026, the United States and Israel launched strikes on Iran. Within 24 hours, traffic through the Strait of Hormuz dropped by 80%. Not because of bombs, not because of missiles, because of insurance. Insurance companies stopped offering cover. And without insurance, no shipping company in the world would send a $140 million tanker through that strait. Today we're going to understand exactly how that happened and what war risk insurance actually means. Let's start with the basics. A ship has standard marine insurance. This covers it against accidents, bad weather, groundings, collisions, your everyday risks at sea. But war, missiles, drones, those are explicitly excluded from a standard policy. You need a completely separate policy called war risk insurance. Think of it like this. Your car insurance covers you in a normal road accident. But if you drove into a war zone and your car was hit by military fire, your regular insurer would say, not our problem. You'd need specialist cover for that. For ships, war risk insurance covers damage from weapons of war, mines, torpedoes, political detention of a vessel, and piracy in some cases. It is priced separately, and it is voyage specific, meaning you pay a fresh premium every time you want to sail through a high-risk zone. War risk insurance is primarily provided through the Lloyd's of London market, a 300-year-old insurance marketplace in London, not a single company, but a marketplace where hundreds of underwriters sit in syndicates and each take a piece of a risk. When you want cover to sail through a dangerous area, a broker shops the risk around this market. Several syndicates each agree to cover, say, 10%, 20%, 30% of the premium, and together they cover 100% of your vessel's value. The key body that sets the rules is called the Joint War Committee, the JWC. This committee publishes a list of listed area zones officially designated as high risk. Once an area is listed, all standard policies automatically exclude it, and you must buy the additional war risk cover separately. At the time of the Hormuz crisis, the JWC was actively reviewing whether to add the entire Persian Gulf to its listed areas, a move that would have made cover even harder to find. Now here's where it gets interesting and expensive. War risk premiums are quoted as a percentage of the ship's insured value per voyage, not per year, per individual sailing. Before the Hormuz crisis, a tanker sailing through the Persian Gulf might pay 0.125% of its hull value for war risk cover. For a $120 million VLCC, a very large crude carrier, that's $150,000 per voyage. Already significant. Once the conflict started, premiums spiked to 1%, then 2.5%. And for US or UK flagged vessels, Lloyd's underwriters were quoting 5% or more. On a $120 million tanker, 5% is $6 million for a single voyage. That's why ships stopped sailing. And some underwriters stopped quoting at all. If you called Lloyd's with a tanker headed through Hormuz in early March 2026, you might simply hear, "We're not writing that risk in any price. No cover equals no sailing." There's a second type of cover that most people don't know about: P&I insurance. P&I stands for Protection and Indemnity. This covers third-party liabilities, crew injury, oil spills, damage to ports, wreck removal. P&I cover is provided by mutual clubs, not commercial insurers. The 12 largest P&I clubs form what's called the International Group, covering 90% of all ocean-going ships on Earth. Here's what happened in March 2026. All 12 of those P&I clubs simultaneously issued 72-hour cancellation notices for war risk extensions in the Persian Gulf. Within 3 days, the liability cover for the world's largest ships was gone. The reason? Their reinsurers, the companies that insure the insurers, withdrew. Without reinsurance, P&I clubs couldn't carry the risk alone, so they canceled. And without P&I cover, ship owners faced unlimited personal liability if a tanker was hit and spilled oil into Gulf waters. No ship owner would take that risk. Let me make this concrete with a real example. Imagine you own a VLCC, a very large crude carrier, worth $120 million. It carries 2 million barrels of crude oil, worth around $250 million at $126 per barrel, the peak price during this crisis. The cargo is worth more than twice the ship. You've chartered this vessel to deliver oil from Iraq to South Korea. The voyage goes through Hormuz. Your costs before the crisis. War risk premium of $150,000. That's recoverable. The charterer pays it under the charter party clause called Maritime. Your costs after the crisis start. The war risk premium is now $3 million. Underwriters want it on the charterer's account. The charterer says that's not economically viable. The voyage is canceled. Your tanker sits at anchorage in the Gulf. Every day it sits, you're paying $50,000 to $80,000 in demurrage. You're not earning revenue, but your costs keep running. This is why 150-plus tankers were stranded at anchorage in the Persian Gulf. Insurance made the voyage economically impossible. When the private market stopped writing cover, something unprecedented happened. The U.S. government stepped in as an insurer. President Trump announced that the U.S. Development Finance Corporation, the DFC, would provide political risk insurance and financial guarantees for ships sailing through Hormuz. He also ordered the U.S. military to escort tankers through the strait. This is historically rare. The last major precedent is the Merchant Marine Act of 1936, which allows the U.S. government to write war risk insurance when private markets fail. Analysts at Morningstar DBRS pointed out the problem. Insurance doesn't reduce the physical risk to crews. Even with government cover, many ship owners refuse to send their crews into a live war zone. Cover helps the balance sheet. It doesn't stop a drone. So let's recap what we've covered today. War risk insurance is a separate, voyage-specific policy that covers ships against acts of war, missiles, mines, hostile detention. It is not included in standard marine cover. It's priced as a percentage of the hull value, per voyage. In a crisis, that percentage can multiply 20 to 40 times in a matter of days, making voyages economically unviable even before a single shot is fired. P&I clubs, the mutual insurers covering third-party liability, can also withdraw war extensions, removing the second critical layer of cover. Without both layers, ships simply don't sail. In the next episode, we're going to go deeper on P&I clubs, specifically what they are, how they work, and why all 12 of the international group's clubs canceled Gulf cover on the same day. That's episode 2, dropping in few days. The next time you see a headline about a shipping crisis or a spike in oil prices, remember, it's rarely just about the missiles. Whether it's the Houthi at the Bab el-Mandeb or a drought in the Panama Canal, the map of global trade is constantly being rewritten by those who decide which risks are worth the price. It's about the fine print in an insurance contract that determines if a ship stays at anchor or keeps the world moving. If this video helped you decode a part of the news that usually stays buried in the financial pages, hit that subscribe button. Global trade is complex, but it doesn't have to be a mystery. Share this channel, Trade and Shipping Explained, with one person in your team or your class who needs to understand how this world actually works. Thanks for watching. We'll see you at the next transit.